Imagine lending a stranger your money and watching it grow into profit without ever stepping foot in a bank. Sounds exciting, right? But here's the catch. What if the stranger doesn't pay you back? Today, we are diving into a financial tool that's changing how people borrow and invest, peer-to-peer lending platforms. By the end of this video, you'll know exactly how they work, why people are rushing to use them, and the risks you need to watch out for before jumping in. Stick with me, because I am going to reveal one hidden factor that could make or break your success in peer-to-peer lending. Number 1. What is peer-to-peer lending? At its simplest, peer-to-peer lending, often shortened to P2P lending, is when everyday people like you lend money directly to other individuals or small businesses through an online platform. Think of it as skipping the bank. Instead of a banker sitting behind a desk approving loans, a website connects borrowers who need money with lenders who are looking to earn interest. Example: Sarah wants to borrow $5,000 to expand her home bakery. Instead of applying at a bank, she uses a peer-to-peer lending platform. John, who has extra savings and wants better returns than his savings account, lends Sarah the money. John earns interest. Sarah gets the cash she needs. Simple. Number 2. Why people use peer-to-peer lending platforms. Borrowers like them because approval is often faster and less strict than banks. Some borrowers can get funded in just a few days, compared to weeks at traditional banks. Lenders love them because the returns can be much higher than leaving money in a savings account. For example, while banks may pay around 1 to 2% on savings, some peer-to-peer platforms advertise returns between 6 to 10% or even more, depending on risk. Number 3. How the platforms actually work step by step. Here's the behind-the-scenes breakdown. Step 1. A borrower applies for a loan on the platform, stating how much money they need and why. Step 2. The platform checks their credit score, income, and financial history, just like a bank would. Step 3. The platform assigns a risk grade. For example, an A-grade borrower is considered safer, while a D-grade borrower is riskier. Step 4. Investors can browse through loan listings and decide which ones to fund. They can lend small amounts, like $25, so their money is spread across many borrowers. Step 5. Borrowers make monthly payments. With interest, the platform collects the money and passes it on to the lenders. Example: if you invested $25 in Sarah's bakery loan and she pays on time each month, you'll slowly get back your money plus interest. Multiply this across dozens of borrowers, and you build a mini lending portfolio. Number 4. The role of risk and reward. Here's where things get interesting. The higher the risk, the higher the potential reward. Example: a borrower with excellent credit may pay only 6% interest, while a borrower with poor credit may pay 20%. If you invest in the riskier borrower, you could make more money, but you could also lose it if they don't pay back. Platforms try to reduce risk by checking credit reports and spreading your money across many loans. But there's always a chance of defaults. Number 5. The benefits for borrowers. Borrowers get quick access to money without the long process of dealing with banks. Some use peer-to-peer loans for debt consolidation, rolling all their debts into one monthly payment at a lower interest rate. Example: Lisa has 3 credit cards with interest rates over 20%. She takes a peer-to-peer loan at 12% to pay off all her cards. Now, she pays less interest and has one simple monthly bill. Number 6. The benefits for investors. Investors can earn much higher returns than traditional savings accounts or certificates of deposit. You also have flexibility. You can choose which loans to fund, how much to invest, and even focus on loans that match your personal values, like lending only to small businesses or eco-friendly projects. Example: some investors choose to support borrowers in renewable energy projects. They get both financial returns and the satisfaction of supporting a cause they believe in. Number 7. The risks you must not ignore. Here's the part most beginners miss. Yes, you can earn higher returns, but you could also lose money. Borrowers might default. Economic downturns could increase defaults across the platform. And remember, peer-to-peer loans are not protected by federal insurance the way bank accounts are. Example: if your savings account goes bust, The FDIC protects your money up to a certain limit. But if a borrower on a peer-to-peer platform stops paying, you could lose your investment. No safety net. Number 8. Fees and how platforms make money. You might wonder, how do these platforms earn? They charge fees on both sides. Borrowers may pay an origination fee, which is a percentage of the loan amount. Investors may pay a service fee, usually a small percent of each payment collected. Example: if Sarah borrows $5,000, the platform might take $200 as a fee. If John earns $100 in interest, the platform might take $1 or $2 as a service fee. Number 9. Diversification is your shield. If you only lend to one borrower, you're taking a big risk. But if you spread your investment across 100 borrowers, even if a few don't pay, the others will balance it out. This is the secret many beginners overlook. Example: imagine you invest $1,000 into one single loan, and that borrower defaults. You lose it all. But if you split that $1,000 into 40 loans of $25 each, even if 2 borrowers default, you still earn from the other 38. Number 10. Real-world platforms you might have heard of. Popular platforms in the USA include Lending Club, Prosper, and Upstart. Each works slightly differently, but the core idea is the same: connecting lenders directly to borrowers online. Some focus on personal loans. Others specialize in small business loans or student loans. Each has different fees, risks, and return rates. Number 11. Who should consider peer-to-peer lending? Peer-to-peer lending is not for everyone. If you can't afford to lose money, this may not be the right place for your savings. But if you have extra money to invest and you're comfortable with risk, it can be a powerful way to grow your wealth. Example: think of it like this. If losing $100 would keep you up at night, stick with a savings account. But if you can handle ups and downs, peer-to-peer lending might fit your investment goals. Number 12. Tips to get started safely. Number 1. Start small. Test with a small amount of money before investing more. Number 2. Diversify. Spread your investment across many borrowers. Number 3. Reinvest. When borrowers repay, reinvest those payments into new loans to grow your portfolio faster. Number 4. Read carefully. Study the borrower's credit grade, history, and purpose of the loan before investing. Number 5. Expect defaults. Don't be shocked if some borrowers don't pay back. That's part of the game. Number 13. Hidden factor you must know. Earlier, I mentioned one thing that could make or break your success. Here it is: timing. Defaults tend to spike when the economy is struggling. If unemployment rises, more borrowers may miss payments. That means peer-to-peer lending can perform well in good times, but may get risky in downturns. Example: during the financial crisis of 2008, many borrowers stopped paying back loans. Investors who had all their money in risky loans lost big. Those who diversified and stayed patient managed to recover over time. Number 14. How peer-to-peer lending is regulated. Unlike traditional banks, peer-to-peer platforms do not operate under the same heavy regulations. They are often overseen by financial authorities like the Securities and Exchange Commission, but protections are limited. This means investors need to be extra careful because fewer safeguards exist compared to traditional financial institutions. Example: if a bank mishandles your money, regulators can step in. But if a peer-to-peer platform fails, you may have limited recourse. Number 15. The impact of credit scores on loans. A borrower's credit score plays a huge role in how much interest they pay and whether they even get approved. High credit score borrowers usually get lower interest rates, while low-score borrowers are charged higher rates because they're seen as riskier. Example: a borrower with a 750 credit score may get a loan at 7% interest, while someone with a 600 score might face 18%. Number 16. Business loans through peer-to-peer platforms. It's not just individuals who borrow. Many small businesses turn to these platforms when banks turn them away. This can give entrepreneurs access to capital to grow their companies without mountains of paperwork. Example: a coffee shop owner might borrow $20,000 through a peer-to-peer platform to renovate their store when their bank denies them. Number 17. Tax implications you should know. The interest you earn from peer-to-peer lending is usually taxable. That means you must report it just like other investment income. Failing to do so could cause issues with the IRS. Example: if you earn $1,000 in interest from peer-to-peer loans, you must include it in your annual taxable income. Number 18. The role of technology and algorithms. Modern peer-to-peer platforms use artificial intelligence and data analytics to assess risk more accurately. This goes beyond traditional credit scores. They analyze education, job history, spending patterns, and even social signals. Example: Upstart uses AI to consider factors like a borrower's college degree and job field to predict repayment. Number 19. Secondary markets for investors. Some platforms allow investors to sell their loans to others if they want to cash out early. This creates liquidity, which is a major drawback of peer-to-peer lending since most loans last several years. Example: if you need your money back before a loan ends, you can list your loan notes on a secondary market to sell to another investor. Number 20. International peer-to-peer lending. Peer-to-peer lending is not just in the USA. Countries like the United Kingdom, China, and India have massive peer-to-peer markets. Each country has different rules, risks, and opportunities. Example: in China, peer-to-peer lending exploded in popularity but faced scandals when unregulated platforms collapsed, costing investors billions. Number 21. How economic cycles affect peer-to-peer lending. In booming economies, repayment rates are usually higher because borrowers are employed and making money. During recessions, defaults can rise quickly, hurting investors. This makes peer-to-peer lending sensitive to overall economic conditions. Example: a platform may report default rates of only 2% in good years, but that number could jump to 8% or more in a downer. Number 22. Social impact lending. Some platforms allow you to support causes like education, clean energy, or microloans in developing countries. These loans may not always bring the highest returns, but they create positive social impact. Example: lending a few $100s to help farmers in Africa buy equipment can both generate returns and improve lives. Number 23. Automated investing tools. Many platforms now offer auto-invest features where you set preferences, like risk level and loan types, and the system invests for you. This saves time and ensures your money keeps working even when you're not actively browsing loans. Example: if you set your preferences for low-risk borrowers only, the platform automatically allocates your money without you having to select each loan. Number 24. Early repayment by borrowers. Borrowers sometimes pay back loans before the full term ends. This can be good for them, but frustrating for investors who were expecting steady interest over a longer period. Example: if you invest in a 3-year loan and the borrower repays in 6 months, you get your money back sooner but lose the future interest payments. Number 25. Peer-to-peer lending versus crowdfunding. People often confuse the two, but they're different. Crowdfunding usually means donating or investing in exchange for rewards or equity, not repayment with interest. Peer-to-peer lending is strictly a loan with the promise of repayment plus interest. Example: supporting a new tech gadget on Kickstarter is crowdfunding. Lending $1,000 to someone on Lending Club is peer-to-peer lending. So now you know how peer-to-peer lending platforms work. You understand the step-by-step process, the benefits, the risks, and even the hidden factor that could decide your success. The big question is, would you ever put your money into a peer-to-peer lending platform? Why or why not? Share your thoughts in the comments below.